All right, well, good morning. Thank you for coming. And we're going to start on Will the Market Fall in 2022? This class came about because a lot of people are nervous about whether we're going to be the people who want to buy, they want to buy, but is it a good time to buy? There's a lot of communication or people thinking that the market is going to fall. They're waiting for the prices to fall in order for them to buy. And they're waiting for a repeat of 2008. There's a lot of things happening. And so what we are doing is we are going to review the data and make our own conclusions. Now, obviously, I don't have a crystal ball, but we are going to review a lot of data that will lead us to make a conclusion whether the market is going to fall or not. Now, you may ask me, well, what makes you so special to be talking about this? And I don't have anything special, but I do have experience. I've been in the real estate market since 2004. I survived the 2008 debacle. And I am a real estate instructor and a licensed mortgage broker, or excuse me, a loan originator. And so it gives me a different perspective from different angles. And I wanted it to tell people that a lot of the things that they're thinking are not founded. And so I want us to review this information together. So let's go and do that. We're going to be talking about three main subjects. One, we're going to be talking about the interest rates and what can we expect with the interest rates. Second, we're going to be analyzing what is happening with the housing market. And third, we're going to talk about the opportunities because believe it or not, there are opportunities in this market. Okay, so first we're going to talk about the interest rates. Now, interest rates tend to follow inflation. And as you can see in the screen, and if you can still see the screen, please confirm that.
Yeah, I can still see it.
Okay, good. As you can see in the screen, there are trends that the inflation goes up, the interest rate goes up. And the reason is because the banks are lending on a 30-year term. And so if inflation goes up, that's going to eat up their revenues. And what that happens is they tend to follow the inflation because if it goes up, they want to at least the future loans recover the losses of the current ones. And that is the reason interest rates follow inflation. As you can see, they're not an exact match, but they're very close. And we have all seen and probably felt in our packets what has happened in the last year with inflation. Obviously, it has gone up. And especially in the last month, we have seen the difference in the interest market and in the interest rates. Now, let's take a look at historically what has happened with inflation and with interest rates. And back in the late 1970s and early 80s, the chair of the Federal Reserve, they saw an inflation rate from 7 to 14%. What happened to the mortgage rates? The mortgage rates went from 12 to 18%. Imagine 18%. We're complaining that the rates are now at 4. The rates were at 18%. What did the Feds do? In order to combat inflation, they raised what is called the Fed funds rate. Now, that is the rate that the Feds charge the banks, not necessarily what you and I pay for mortgages, but what they charge the banks. And so that particular rate went from 11% to 20%. Now, it had an effect in the market. It did take a toll on inflation, and inflation went down from 14% to 5%. It also had an effect on mortgage rates, the same. It went from 18% to 12%. So that worked. Now, what happened to the market? The S&P did not like that. And it went down 30%, which triggered a recession. Okay, let's move forward to the 90s and into the 2000s. Alan Greenspan is now the chair of the Federal Reserve. He saw an inflation rate from 1.75 to 3.75. The mortgage rates follow suit from 7% to 8.5%. Alan Greenspan learned the lesson from Burns and Volcker not to wait too long. So he reacted immediately and raised the Fed fund rate from 4.75 to 6.5%. That also worked. It had an effect on inflation. Inflation went down from 3.5% to 1%, and then mortgage rates followed suit from 8.5% to 5.5%. What happened to the market? S&P did not like it either. It went down 50% and it triggered a recession. Now let's see what happened nowadays. The current chair is Jerome Powell. He has seen the inflation go from 1.75% to 7%. He has not reacted fast like Alan Greenspan. Why? Because he thinks it's transitory. Now, the mortgage rates have gone from 2.5% to 3.375%. What is he going to do? Now, if he follows what historical has happened, he could raise the rates. Currently at 0%, he could raise it to 1% in 2022. Now, that should control inflation. The rates should come back down, but it may trigger a recession. Now, here's the trick. We don't know necessarily what the Fed chair is going to do, because yes, they announced last year they're going to raise the interest rates. However, they also have other options, okay? And some of that other option is to let their balance sheets run. And that has different effects. So depending on what they choose to do is what's going to happen with the market. If they raise the Fed fund rate, the inflation most likely will come down and the rates will come down. But if they let the balance sheet run, they may try to control the inflation, but the interest rates will be impacted and it will go up instead of down. So this is why the market is so uncertain right now. Now, we have to recognize that we have to understand real estate at two different levels, because real estate is specific to the area. So right now, everything that we're looking at is the federal level. Let's see what happens when we look at Florida. All right, so let's shift our view for a moment. I want you to look at the screen and see how recessions historically also have been cyclical. So we had a recession in the 50s, another one in the 60s, another one in the 70s, another one in the 80s, in the 90s, in the 2000s, and then we had the Great Recession in 2008. That is cyclical, and so it is normal for us to expect a recession in our market. Now, what happens to the market when we are in a recession? Well, traditionally, what that means is that there are more houses available for purchase, and so the buyers have more leeway. They have more to choose from. Is that what's happening right now? When you look at the news, you can hear some scary titles like, oh, the market is going to crash, and it is very alarmist, if you will. However, that is true, and it might be true in some states, but it is not necessarily true in Florida. Okay, when we look at the Florida realtor statistics, we see that the Florida market has taken off since COVID, and it has not come down much. Okay, here are the statistics for the 2018 to 2021. The year in black is 2021, and we see the market ended up on the high. Now, this is the key of what's happening in Florida. According to the United States Postal Services, we see that there have been permanent changes of address to Florida from places like New York, Los Angeles, Washington, San Francisco, Chicago, Las Vegas, Philadelphia, Denver, Seattle, and even Atlanta. And so the influx of the migration from these places has taken a toll, in addition to the international migration that we've always had. That is what has happened to the prices in Florida. These people are moving from places where prices are a lot higher. They come in to buy cash or to buy above asking price, because for them it's still very cheap, and is raising the price up. Also, the fact that there is not enough inventory. And of course, when we have little inventory, the prices go up. It's the law of offer and supply. Now, here is proof of what we already know, that the prices have gone up. Look at from 2011, and now a normal house is probably in the $350,000. This is another myth that I want to talk about, because a lot of people are saying, well, with COVID, there's going to be a wave of foreclosure. There's a huge wave that is coming and we're not seeing yet. Personally, I don't see that happening, and I'm going to tell you why. As a listing agent for the banks in 2008, I can tell you that in 2008, we had 24 months of inventory. That means that if we didn't list anything else for 2 years, buyers will continue buying at the same pace and we will still have houses for 2 years. That's incredible. 24 months. Today, we have 2 months. And that is what we're seeing. People are desperate because there's not enough inventory. So even if there is a wave of foreclosures, which I don't necessarily expect that either, and I'll tell you why in a minute, even if there is a wave of foreclosures, and there might be some of them, the market will absorb them in such a way that it will not affect the prices, because it's not like the inventory all of a sudden is going to raise and there's houses to buy all over the place. And so that is, in my humble opinion, not going to happen. I do not see a wave of foreclosures coming up. Now, the second reason I don't see a wave of foreclosures coming up is because in 2008, the banks learned the lesson. I'm not going to say they lost money, but they had to be responsible for a lot of expenses. And we personally saw houses being destroyed by the people leaving the house, holes all over the walls, the pools were completely damaged, the piping where they pour concrete down the pipes, and these houses had to be, not all of them, but some of these houses had to be completely redone. In addition, the banks had to pay for the homeowners association back dues, the back due taxes, and the real estate fees and everything else. So it was a very expensive proposition for them. What they have learned is that there is a better way to do it. They're going to keep the homeowner in the house. And instead of saying, oh, you're going to go to foreclosure, you're going to say, well, let's modify your loan. We're going to put what you owe and put it at the end of the loan. You continue paying, no problem. Or we'll refinance for 40 years. Now that is a product that is being offered, but not to everybody. Only to people who are refinancing their homes. So refinancing for 40 years, that lowers their payment. The people are still in the house, everybody's happy, and the bank does not have to take up that expensive bill. So for those two reasons, in my humble opinion, we will not see the wave of foreclosures that a lot of investors are waiting for. It is possible that it's going to happen in other states. I do not see that happening in Florida because people continue moving here. Now, we also talk about the inventory. Builders have been trying to catch up, and their inventory for the building permits have gone up. However, that is still not enough to supply everything that we need. And the main reason is because of the labor, not everybody's working. Also, the cost of the materials are going up. So there's a lot of other reasons that complicate the matter. But the fact is that inventory will remain low. As long as the inventory is low, then the prices will continue to rise. Now, are they going to rise at the same level? No. And that is something I want to clarify, because last year, properties went up 20% in appreciation. That is unheard of. That is super high. Something normal. A normal appreciation is anywhere between 3 and 5%. So 20% is unheard of. Is it sustainable? No, that is the reason why it cannot continue. Does that mean the market is going to crash? No, not necessarily. We expect this year, 2022, it depends on what expert you read, but the expectations are that the appreciation is going to go up anywhere between 7 to 9%. Okay, so some of the titles in the news say, oh, it's crashing from 20% down to 20. Well, is it really crashing? No, it's decelerating, but it's not crashing. The market is not going down. It's still growing. It's just growing at a slower, healthier pace. We don't want the market to be so crazy that then it will go will get out of control. We want healthy, slow growth. That is something that is sustainable. Something else that is important to see is the Florida employment. So Florida not only has beautiful warm weather, but we have no state taxes, we have no inheritance taxes, and out of the pandemic, we have recovered probably the fastest. In fact, the latest report for employment out of the entire United States, Florida was responsible for 25% of job creation. So that's a big difference. And it speaks of what is happening in the Florida economy. Because if it has recovered now, of course, we had a dip there for COVID that kind of took us all by surprise. We were not expecting that, but we recovered fairly quickly. Finally, I'm going to talk about opportunities. So opportunities, what opportunities can we see in this market? A lot of people are scared. Number one, I see that the interest rates are going to continue to go up. It's not sustainable for interest rates to remain in the 2%. It's not, the normal is anywhere between 7 to 9%. So interest rates will continue to go up. Now, are they going to go straight up? No, maybe they will go down. There's a little dip and then we'll come back up. It's not something that's going to be happening overnight, although this last month we saw a significant increase in the interest rate. One of the opportunities then is the interest rates are going to go up and the prices are going to go up. Even the rental prices are expected to go up. And so if those two are going to go up, is it going to be more expensive to buy in 2022 or 2023? Forget about 2021. It's gone. It's in the rearview mirror. We can't do anything about 2021. But the reality is that in 2023, most likely you're going to end up paying more for the same house. So it is a good time to buy right now if you can afford it. If you are ready for it, definitely I would suggest get into a property, even if it's something small, even if it's something that you're not necessarily the house of your dreams, because down the road, then you can use that property and escalate into something bigger, better, beautiful, and continue either rent this particular property that you already bought or just sell it, get the money out and move on to the next one. So that is one of the opportunities. Buy now before 2023, because it will, in my humble opinion, be more expensive. The second opportunity is, I'm going to talk about the inventory. I know inventory is low, and sometimes when people go out there and look for houses, they get discouraged because they can't find what they're looking for. Now, obviously, we all like the beautiful model home looking houses, but sometimes they're out of the price range or the competition is too fierce. There's another product I want to tell you about, and that is the remodeling product. So if as a realtor, you're buying a property or you're helping your clients buy a property, and you can't find exactly what you're looking for, but you can find in a location that is good, that property can be remodeled. The kitchen can be done, the roof can be redone, everything can be remodeled and bring it up to the standards of the buyer. We have a special loan for that where all the cost of the financing will be rolled into the loan, and the construction won't start until they own the house. So the way it works is choose a property. There is a general contractor that has to take care of the construction, obviously. The client will tell the general contractor what changes they want. General contractor prepares a list that is passed on to the appraiser, and the appraiser is going to take all of those changes under consideration, and they will give us an after repair price. The loan is going to be based on that amount. And the closing happens and construction starts after closing, and the owner and the general contractor have 6 months to complete the project. And so the opportunity here is that if you find a home that is being burned, it has ugly kitchen, ugly bathrooms, holes in the roof, all of that can be repaired. And the beauty of it is that it can be repaired to the like of the owner, or the new owner, of the buyer. And so that is a great opportunity there. If you want some more information about the home repair loans, let me know and I'll send you a brochure or sit down with you and give you more information. The second opportunity is for people who already own the home. This is a great opportunity because so much appreciation was last year. You can actually do a refinancing and include all the debt that you have, do a debt reconciliation and have one payment, one at a low interest rate, which is still low, And you will be saving thousands of dollars. I have done that for many clients. I had a client who actually saved $1,000 a month by doing a refinancing loan and a debt reconciliation. One of the reasons is the credit card interest rate is expected to rise to 16.9%. So obviously that is going to be impacted as well, because credit cards are variable interest rate. The home interest rate is going to be fixed. And so if you have any debt, this will be a perfect time to consolidate it into one low fixed interest rate so you can attack that and get out of debt as soon as possible. So that is the presentation for today. I'm going to open it up for questions and answers. If you have any, let me go ahead and stop sharing my screen and let me know if you have any questions.
Hello?
Hi, Juan.
I have a question, like regarding more like of the future.
Yes.
Like I know you said the interest is rising and house prices are rising and rent. So what about those people that is it going to be harder for them to afford places, because since rent is higher, interests are higher, so they can't buy, they can't rent. So what is that like going to do to the economy?
It's going to be a tough situation for some people. What is the solution for that? I don't really know. If there are kids that are living at home, maybe they will stay living at home longer so they can save up. Down payment assistance is a possibility, but remember, down payment assistance has its downside as well, because most of the programs up there will have to pass a second underwriting program. And so that means that it's a longer time for closing. We have one down payment assistance programs that our underwriters are approved. And so we can do just one underwriting. And if you're interested in something like that, if some of your clients are interested, then let me know. But the way down payment assistance is working now is almost like a help for the closing costs, because now we can't ask the sellers for closing costs anymore because they won't even consider the offer. But we use the down payment assistance to cover the closing costs. The buyers still have to have their down payment out of their pocket.
And also, I would be interested in, I'm not sure what you called it, but it was where you like repair the firehouses and that kind of program. Is that program? Yeah, I think it was the remodel.
The remodeling program, yeah.
So is that for the buyer or the seller? What is it?
Could be for either one. So if somebody is getting ready to sell, it depends on how we structure it. If somebody's getting ready to sell as an investment, then they need to remodel and they need to stay in the house for a certain period of time. But if it's a buyer, they can still do a remodeling loan. They can buy a house ugly as it is. They have to have vision. That's the only thing. And if you have buyers who have difficulty having the vision of what it will look like when it's done, we have beautiful programs, and I have a designer on my team that could actually show them what the after will look like for them to be able to visualize the final product. And so that is available for the buyer as well. It's available for both, to answer your question.
Okay. And would it have I guess, like estimated value of the property after the repairs to see if it's like, let's say like for an investor who is looking to buy and they, I guess, can take out a loan to repair it and then flip?
There is a type of product for that. Yes, there is one that is specially for investors, and that one doesn't have a time frame where you have to stay in the house. They can just flip and continue. Yes, that is going to be determined by the appraiser. Okay, we have the buyer or the owner in this case decides what changes are going to happen, and they give that information to the general contractor, who puts it in a special format, and then it gets submitted to the appraiser. And then the appraiser is going to take those changes under consideration and say, okay, the after price is going to be X. And that is what the loan is going to be based on.
Sounds like a great program, to be honest.
Yes. It's fantastic because in essence, what you're doing is you are creating inventory that is not out there. If you're going to sit and wait until something hits in the MLS, you're going to have 50,000 offers in that one listing. And so you have to kind of be strategic about this and look for other options where the ugly ducky, if you will, where there is not that many people interested in there because it's ugly, because it's old, because it has a hole in the roof, whatever the reason. But with this type of programs, we can take the house all the way down to the slab and redo the whole thing. So essentially you're getting a brand new house.
I have a question like regarding, I guess, on the seller's perspective. Like, let's say someone has a burnt down house. They wouldn't be living in it, but they want to fix it. So how would that work? Because you said it's a live-in period.
Okay, I think I got confused there. Let me make sure I understood. There's a burned down house. Do the people own the house? They want to do the repairs, or are they selling it?
I guess they want to repair it and then sell it.
And then sell it. Okay, so they would have to get the loan, the rehab loan, decide what changes are going to be done. And then we do the loan and the work gets done. And then they have to, it depends on what type of loan we do. They can either sell it right away or have to wait a period of time. And then we can do it. I mean, I don't know if I answered your question, but.
Yeah, you did. What is like the difference between selling it after the repair is done, or because I know you said you have like a wait period, or
the main difference is going to be whether it's considered a primary residence or an investment property. If it's an investment property, there's different rules, there's different percentages, and the interest rate is slightly more expensive. And if your primary residence, you are living there, you're expected to be living in the house, so you're expected to stay there for a period of time before you can sell.
Okay.
Any other questions?
Not that I could think of at the moment.